Hey everyone, Hunter Satterfield here, one of the partners at Kane Waters as well as the Chief Investment Officer. As always, I am joined by Brad Sanders, the Managing Director of Tectonic Advisors. Unfortunately today we're missing Brian Bortz, my fellow partner who heads up the investment committee as well. He'll be back with us next month. This is your October market update. For the month of October, the S&P was up 2.3%, the global stocks were up 2.1%, and then in the fixed income markets, domestic bonds were up 0.6, with global bonds down 0.3. So another excellent month. A lot of what we've been talking about on this, as well as our podcast recordings, about largely been a good year with some bumpiness throughout, which certainly we'll talk about with Brad here in a second. So Brad, let's start, before we get to the Fed decision, let's start with sort of what happened in the market. So I don't know that 2% in the S&P tells the full story. Obviously, we had some pockets of the market that did better, including tech. You want to talk a little bit about sort of just the fragmentation in the market in October?
October was all AI. So if you kind of strip that out, nothing else really worked. If you look at the S&P 500 equal weight, where you take the S&P 500 and you just give all 500 companies the same weighting, it was actually down 1%. So you can look at that as the broader market was actually lower. One small subsect, which actually happens to have a lot of capital attached to it right now, did well and kind of drug everything along. So if you're like zooming out and looking at the market as a whole, it didn't look very good. Just the headline numbers did. Kind of been the story here for the last 6 weeks, like end of September and then into October. And we're starting to see a lot of volatility surrounding that. We also had third quarter earnings start about the last week of October, and we're starting to see stocks make major moves just based off earnings. So like, I'm not talking 4 or 5%, I'm talking down 20, up 20, which usually just is a good sign that there's going to be a lot of volatility probably for the next several weeks as we move through those third quarter earnings at least. Not to mention the government being shut down and all the geopolitical stuff going on. So it's just the soup is hot right now. There's going to be a lot of volatility, but the market's still grinding higher. So all in all, it's not something to worry about. It's just something to be aware of. If you're looking day to day, you're probably going to have some days that are kind of eye-opening just because of the way the market's moving around.
Yeah, and thankfully, thus far, the Fed has tried to remove some uncertainty. Yeah. They have followed the playbook that we have talked about. So the Fed decision last week, for those that are not aware, the Fed decided to cut another 25 basis points, the second cut here just since the end of the summer. There was one person that dissented. They were looking for a cut of 50 basis points, another that didn't want one at all. But again, largely the Fed is following the playbook that we've talked about. Brad, we've got one more meeting this year. We anticipate probably another quarter point. So we're probably getting down to like 3.5 to 3.75 on Fed funds by the end of the year, with more to come next year. Brad, you want to talk a little bit about sort of what the Fed, because they talked both about inflation risk, but then also job market risk as well, which is that dual mandate. You want to talk about kind of why they went with the 25 and why we're anticipating probably another one before year end?
Yeah, I think on the job side gave them the cover they to actually cut and feel comfortable about it, because there still is upward bias to inflation, and that has to do with tariffs and monetary policy all the way down. One thing they also did is they ended quantitative tightening, which has been going on for half a decade now. That's the opposite of quantitative easing, which we all kind of got to know. Quantitative tightenings when they're actually retiring the securities on their balance sheet, not buying new ones. They're going to stop that. So that's actually going to be another thing that's going to help loosen things up monetarily. But they did see, the market didn't kind of sold the news, because when Powell came out and announced the quarter point, that was already priced in. And then he kind of tried to throw a little cold water on December, saying, hey, that's not a foregone conclusion. The market's already priced that one in too. So the market got really volatile that day. I think the reason he's doing that is there are some upward biases to inflation. The tariff policy is still ongoing. We're starting to see some of that trickle in. But also the government's still shut down. And a lot of the economic data we get comes from the federal government, and the longer you go where that's shut down, the less and less data that you can trust you're getting. And so I think he's leaving cover going, if we're seeing signs or we're hearing things about the economy, but we can't get good data, they may be reticent to actually cut that if things were to kind of stay shut down that long. Hopefully they're not. Hopefully there's rumblings that we're going to get a resolution soon. But I think that's part of why he's given himself an out. If that were to continue to happen.
For sure. I mean, we're 10 months in here, y'all, and really, again, the markets have broadly moved higher this year, which is sort of what we had anticipated and what we've been talking about for a lot of this year. And obviously, there's a lot going on, both as Brad mentions, the shutdown, as well as some of the Fed policy things, but then also CapEx and AI, as he mentioned as well. And there's just a lot of things that are sort of balls up in the air that the sort of economy is trying to juggle right now. So it will be an interesting next 2 months as we sort of go to close for the year. I mean, again, I think many of the things that the Fed is doing by cutting rates and then again ending quantitative tightening are broadly bullish for the economy starting to reopen. So we'll be back in front of you with sort of the impacts of that, but it's still going to take 6 months, 9 months for this stuff to flush through the system. So don't anticipate big swings and changes necessarily in rates yet. But they certainly will happen as the Fed continues on this rate cut cycle. So we'll be back in front of you at the end of October. Hope everybody has, or at the end of November, excuse me. Hope everybody has a wonderful Thanksgiving. Thank you.